Listen to This Week in Money, Saturdays on Internet Radio at TalkDigitalNetwork.com. This week's scheduled guests from Chartworks, Ross Clark. From the Gloom, Boom, and Doom Report, Mark Faber. From WolfStreet.com, Wolf Richter. Plus company showcase interviews with Larry Ray from American Manganese and Don Mosher from Cypress Development Corporation. Don't miss This Week in Money this Saturday on Internet Radio at TalkDigitalNetwork.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton, where the weather went from the middle of summer to midwinter overnight.
Yeah, it's amazing. You know, we have two seasons, winter and summer, but, you know, when the summer finally comes, you'd expect that it would actually stay for a while. But I don't think it's supposed to be this cold for much longer. It's just a kind of a throwback, I guess.
Hilliard, talking about chilling things, real estate across the country, prices are coming down, except I've noted in Montreal and in the general Vancouver area where people can't afford the houses, so now they're going after condos, and that's really boosting prices, although I don't know if the Real Estate Association has recognized that yet.
Yeah, the condo phenomenon is quite shocking, actually, because I guess it's a triumph of marketing over common sense, if you like, I guess, because really if the single family homes and the more expensive properties, which have all the land associated with them, are declining in price, as they are and have been in Toronto for a year and in Vancouver actually for 2 years now, then you wouldn't think that would allow for a buoyant market for boxes in the sky that don't really have any land associated with them. But apparently it does allow that, and I guess it's because people need to live somewhere, and rents are rental places are hard to find and they're expensive, and also people would prefer not to be at the mercy of a landlord, evicting them, and so they're willing to pay up for these small condos, prices that I just find shocking and ridiculous. They're marketing them in Edmonton and Calgary and Montreal. There's a boom on in Montreal and Toronto, but that's not something that is normally associated with long-term building wealth in real estate, because the only thing that really goes up in value is the land underneath it. And when you buy a condo, especially a high-rise condo, you don't get much land. Maybe 10%, maybe 15% at the very most, and of the purchase price is the land, and the rest is the building. And so the building is brand new when you buy it, but it's like a car. You drive it off the lot, it immediately starts to lose value. So, and then of course eventually it requires dollars to maintain and refurbish, and what I've noticed in the last 3 years is almost every new building has a lawsuit associated with it as well. So, because there's some problem that the developer didn't build the plumbing right or something like that. So it's the real estate bubble, and the bursting of the bubble will unfold, and it'll take years. And I think this is just a short chapter in a long book with several chapters in it, with many chapters in it, but it is odd. It really is odd.
Well, the biggest drop in property values been in where? West Vancouver, which was the most expensive property in Canada and still is.
Yeah, there's places in Toronto, I guess, that are close to that, but from Horseshoe Bay over to Capilano, that those houses, there's hundreds of them for sale right now in the $2 million and up range, and the problem with that is the average person, or even the relatively high income person, really, is reluctant to buy something that expensive. And apparently, now there's really no way to measure this, but apparently the foreign buyer from China mostly, but also from Iran and other places, those buyers have disappeared. Whether they've gone to Seattle, or whether they're just staying home, or whether they're hiding because they're afraid of getting identified. But who knows? But anyway, the so far the price drops have not been that spectacular, because people have their anchor price. They say, oh no, that house down the street, which is not nearly as nice as my house, sold for $2 million, a year ago. So therefore, I should get at least that much. So they price it based on the peak in the market, and it takes them a long time to adjust to the reality that the prices are probably going to be lower. And so we kind of got a situation where, I forget the exact number of what it was. I think transaction sales are the lowest they've been since they dropped 64% year over year, and they're the lowest they've been since records first started being kept. So it's so the first step in the whole thing is just the transactions dry up because the buyers and the sellers are too far apart on their pricing, and then eventually people are either forced to sell, or maybe the buyers come back and the price, but the seller might hold out and eventually get his price or her price. But it's, in this case, more likely that it'll be the activity will pick up again at the lower price levels, which will, as happened in the U.S. and other countries where there's been a bubble bursting. When they start to transact at those lower price levels, it creates all kinds of problems, because now you've got people that are underwater in their mortgage and they can't get refinanced, and they can't, it just goes on. And people that thought they were in great shape with 30% equity find out that the bank won't talk to them, and we aren't there yet. Obviously, that's a ways off, but it may not be that far off. It may only be a few months off.
Well, the NDP government increased the foreign buyer tax from 15% to 20% and expanded it to basically anywhere a human would want to live in British Columbia. They also have a speculator tax, has a very high tax rate on non-primary residences, which means if you own a cabin, or an Albertan who has a cabin in BC, you may end up paying a horribly high tax on it. So why would you want to hold on to that property? They may have wanted to throw a bucket of water on the real estate market, but I think they've parked an iceberg on it.
Well, maybe, and there's no way to test for this, right? Because in real life, this is why economists like to work with models. They don't actually like to work with real life, because there's no way to isolate what was probably going to happen in the real estate market in Vancouver and in BC anyway, because Alberta's still going through a pretty major downturn, and a lot of them, especially in the Kelowna and other areas like that, the money comes to a degree from Alberta. There probably was a downturn coming anyway, so, but we'll never know. We'll never know. When people look back on this, they'll say, oh yeah, it was the NDP government with those taxes and stuff, but maybe it was just time for it to start to correct. But the fact that it's correcting in Toronto and other cities at the same time indicates, it bolsters the argument that it was due to happen anyway. But yeah, I mean, I'm based in Alberta, and there's a lot of very upset people in Alberta that bought, future retirement homes that they were just occupying for a month in the summer, and then they bought ahead of when they need it, maybe by 5 or 10 years. Now they're irate that they're going to have to pay 2% a year in tax, which is and that's not the only thing they're irate about.
We'll have more with Hilliard MacBeth right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, oil touched $70 a barrel briefly. Do you expect the price of oil to continue to go higher?
Well, you kind of think it will because of the unilateral withdrawal from the Iran nuclear accord by the U.S. President Trump. And I was just doing a little research going back to 1945. There's been 11 recessions, and 10 of them have been preceded by a jump in the oil price. So the oil price right now has gone up from $30 to $70, which is about 133% increase. And that's the second largest increase, by the way, over a short period of time prior to a downturn in the economy. And every time the oil price has gone up like that, there's been a downturn in the economy. So a recession, I guess you could call it. So, and we kind of are overdue for a recession anyway, because it's been basically 10 years since the last one. Usually they come along every 5 or 6 years. So and then on top of that, the Iran deal, and I don't know how important this is, but it seems like it might be very important because you might have noted that several countries, like France, sent their top politician to Washington to talk to Trump to try and talk him out of doing this, and also I'm reading that his own advisors talked him 3 times out of, apparently according to the New York Times. 3 different times talked him out of withdrawing from the deal, and so what he did, he fired those advisors and got new advisors. So now he's done it. So he got advisors that would agree with him, and so now he's done it, and it's probably a significant event. That's the other thing that there's a paper by the National Bureau of Economic Research. James Hamilton talks about these events. And the other thing that happened associated with the oil price move was usually an event of some sort, like the Suez crisis, which nobody remembers, but things like that. So maybe this will become the oil price. Now you could say, and some people would say at this point, well, yeah, but it's different now because the U.S. is less dependent on oil than it was at any time, like in the 70s. And that's true. The automobiles, for instance, are much more fuel efficient than they used to be. But the U.S. and the second thing too is the U.S. has all this new shale oil, so they don't import much oil from the Middle East anymore at all. In fact, most of the imports, they import between 7 and 8 million barrels a day. More than half of it comes from Canada. So and they actually are exporting 1 to 2 million barrels a day now as well. So the U.S., this jump in prices above 70 is going to increase the U.S. production from shale dramatically. There's lots of people working on that. And so they're not as exposed to Middle East politics as they were. But having said all that, in the past, when the oil price went up this much, it triggered a number of political and economic events resulting in a recession almost every time. And so we shouldn't just assume, oh, this time it'll be different. We should think, well, the odds are pretty high that this time we'll also get a recession, and we should watch for that very closely.
We'll have more with Hilliard MacBeth right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, when it comes to the stock markets, what are you telling your clients who are concerned that we might be in for a major correction?
Well, we have to be careful. It's the Canadian market, as you and I have discussed several times in the past, is quite vulnerable to factors like the real estate bubble and the oil business that are specific to Canada. So a person would be really well advised to diversify outside of Canada, but then it's still not entirely simple because the U.S. Stock market is very expensive right now. So it's never really been this expensive, except for a brief period during the 1999-2000 internet.com bubbles. And so this is the second most expensive market ever, even including 1929. So we have to be careful about the U.S. market as well. So, and in a recession, usually what happens is when we get the next recession, the stock market corrects everywhere. It doesn't just correct in specific sectors. One of the issues with this thing that's going on now is that the U.S. interest rates have been rising, and for the 10-year they're above 3%, which makes for a stronger dollar, which hurts a lot of people and countries that have borrowed in U.S. dollars. And there's a whole bunch of emerging market countries that are forced to borrow in U.S. dollars because they never developed the ability to borrow in their local currency. Nobody will lend them money in the local peso, let's say, so they have to borrow in dollars, but then they have to repay in dollars. And if their local currency drops and the U.S. dollar rises, as it tends to do in times of economic crisis or economic recession, then they have trouble repaying. So it's so what we're doing is we're keeping a lot of money in safer investments like bonds and even medium short-term bonds, and diversifying into areas where prices aren't as elevated like Europe and Japan, but with an eye on maybe being ready to make a move to a safer haven if the signs are there. There are a lot of people that expect this current bull market in stocks to continue for a few more months, but 2019 and 2020 for sure, the odds of a recession go up pretty dramatically. And when there's a recession, there's almost always, or I think you could even say always, a bear market in stocks.
Which, of course, if you're a rich person, you wait for the market to fall, and that's when you snap up stuff. But for the average person, do you just take cash out of the market now and just park your cash somewhere waiting for lower markets?
I mean, if you could do that, if you were disciplined enough to do that, the difficulty with that is you miss out. If say it lasts another year, sometimes the gains are really good right at the end of the run. And secondly, if you do take your money out, one of the things that happens kind of interesting is people have tried all of these things. Is people that take their money out of the market get very negative on the stock market, and they start searching the news to justify their decision. So they see all kinds of negative news, and they don't see the positive news. So then, when the market corrects and prices are really good, they usually fail to get back into the market, and so they miss at least the first half of the upswing. In 2009, the upswing, most of the upswing was over within 6 months. It was amazing. I mean, the market carried on for longer, obviously another 8 years, but the gains in the first few months, which somebody who was out of the market almost for sure missed entirely, were the best. So we counsel people to keep some money in the market. Never be entirely out of the market, never be entirely in the market. And that psychologically helps you be prepared to add money when the prices are really low and take some money off the table when prices are really high. But the all or nothing in out thing, people, and I'm sure there are a few people in the world that are able to do it, but it's very rare. The personality required is very, very unique, and most people don't have it.
Hilliard, thank you so much for chatting with us.
Nice to talk to you again.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. If you have any questions for Hilliard or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.